With an S&P 500 trading above 27 times earnings, it is definitely getting harder and harder to figure some things out here. Now, my 2025 strategy is completely changed and we're going year to date, and I'm going to share all my moves with you. And with Trump throwing tariffs on China, Mexico, and Canada, the market took a interesting turn yesterday. And we are going on a year-to-date strategy versus the indexes, and let me explain what I'm going to do here. If you're familiar with the dogs of the Dow, that's kind of the avenue I'm personally taking here. I am buying the trash that everybody's throwing away, and I still think has some value and could actually outperform substantially. Because as this market is getting more and more expensive, and we're seeing some crazy divergences between the expensive stocks getting more expensive and the cheap stocks getting even more cheap, I'm gonna go shop in the cheap aisle and buy a bunch of different companies here that are flying off the shelves at record low prices. Now, disclaimer, do not try this strategy at home. This is just my personal risk taking, my personal journey, and let's get into what stocks I bought this week. Now, I'm going to run an equal weighted strategy with my larger cap companies and an equal weighted strategy with my smaller cap companies, investing between 3,000 to 4,000 in my smaller cap companies and around 7,000 to 8,000 in my large cap companies. And if somehow some high quality company absolutely crashes, like an Apple, like a Google, if we see a substantial crash in these names, they will be making up a large portion of my portfolio, basically exceeding that $7,000 threshold and going closer to $9,000 to $10,000 investments. As you can see here, I have over $9,000 in cash, and this is specifically designed for one of those names to fall. Now, the first up here, you are looking at Vici Properties. I have 257 shares of Vici Properties sitting around $29.50. Now, ideally, I wanted to buy this between $25 and $26, but real estate's been a massive underperformer and it's showing some signs of life, and I figured this would be the good time to buy Vici. When we look at Vici Properties, most of my return is going to come in the form of a dividend. Just like most REITs, you're going to have most of your returns come in that form of a dividend. At 5.8%, this is very competitive with most REITs, and the valuation is extremely compelling when we factor in the growth rates of this company. We can see here for the last 5 years, it's basically traded between 27 to about 35 bucks a share. Running in quicksand hasn't moved over the last 5 years. And I do think real estate is definitely a contrarian trade when we talk about 2025 and interest rates being higher for longer. I think this one can surprise most on earnings and actually outperform most REITs. When we talk about a picture perfect of earnings increasing and revenues increasing, but yet the stock has stayed the same price, to me, this is an opportunity I think makes a lot of sense, especially with nearly a 6% dividend yield. And that's why this is the largest holding in my portfolio. I think it's fairly safe compared to my other investments, and I need some safety here to offset the risk that I'm taking on. And I think Vici fits that profile. Now, of course, I absolutely think real estate could sell off if we see rates spike, and I would have to be willing to reinvest those dividends into Vici. But at $29.50, I don't think I got a steal. I don't think I overpaid. I basically think it's sitting around fair market value. Schwab gives it a rating of a B+, basically saying it's a market outperformer, not a substantial market outperformer, but it should outperform most market indexes. And most people give it a $30 to about a $35 price target, which means there's probably not going to be a tremendous amount of upside at $29.50. But as I stated, I'm not looking for a tremendous amount of volatility in this name. I'm just looking to collect that dividend and maybe get some appreciation on earnings beats. Which is going to lead us to our next largest name here is Intel Corporations. I have 385 shares. I bought the majority of them around $19.75, which means I'm slightly down in the position, but I actually like what's taking place with Intel here. On a 1 year basis, this stock is down 55%. And when we take a look at what Schwab thinks, they basically think this could be a market performer. Morningstar gives it a 3-star rating. Once again, a market performer. Nobody really wants to own this company. Nobody really wants to put a price on this company because essentially it's too hard to do so. It's really hard to tell where Intel is heading. Now, I don't want to get too deep into Intel because I already did a video which I'll leave above, but I do believe we are starting to see some light within this name. Now, Morningstar believes that $21 is fair market value, and I can get behind that. I think between $18 to $21 accumulation in this name could make sense considering they don't have a CEO and a merger is definitely on the table, I believe, at these levels. If they get a CEO or there's a merger that actually goes through, I think we're looking at a $30 to $40 stock. Now, with that being said, if they do nothing and keep heading on the direction they're heading, it seems like the ship is turning around. December quarter, they did $14.3 billion, which is down 7% year over year, but up 7% sequentially in the high end of their guidance of the quarter. Client revenue fared well, up 9% sequentially. Data center and AI rose 1%. Now, that's a little disappointing to me. I thought the opportunity for them to capitalize would actually be the data center and AI. When we look at business outlook, we still expect Intel to remain the market share leader in central processing units, CPUs, and this is why I still think you have to remain bullish on the name. CPUs have been extremely weak. Intel is not only getting $1.1 billion in December from the government, but they're also getting an additional $1.1 billion in January, which is giving their balance sheet some serious strength, considering that they've been burning some capital here. We've also dealt with a very weak CPU market. If the CPU market can turn around, Intel is positioned pretty uniquely to have outsized gains when we compare it to the market. It's priced well below book value, sitting around 85% of book value, which means that if they liquidated, you have 15% equity in the name. And the bulls say that Intel is still one of the largest semiconductor companies in the world and holds the lion's share of PCs. And I think the biggest bear case is, even if Intel can regain manufacturing and get back on their feet, they lost a lot of credibility. And I do obviously think there's some truth to this, but I also think the stock is being priced for that. And so anything under $20 a share, I think is interesting. Ideally, I did want to get this between $17.50 and $18. So I did pay about a 10% premium. But when we're talking about at these low levels and they could be merged at any moment or a new CEO can be announced at any moment, I think it makes sense to put some skin in the game today, which is now going to lead me to Pfizer. Obviously, we all know this one has been pretty much a disaster for the last couple years. Over the last 3 years, Pfizer is down 51%, but when we look at analyst expectations, Schwab gives it a C rating, basically putting it in line with market. Morningstar gives it a 5-star rating, and they believe that fair market value is sitting closer to $40 a share. Now, if we topple that with the massive dividend that they're currently paying of nearly 6.5% dividend yield, trading at a forward PE, which I believe is closer to 12 times than it is to 9, which is historically low. Historically, Pfizer trades around 13.5 times forward earnings, and I think this is undervalued. Now, originally, I was a little nervous entering in this position, especially when the strength of their earnings is already past, and I think that this quarter is probably going to be a little bit weak, but I still think you're buying a good company at a good price that has a high yield. So adding both Vici and Pfizer as yields allows me to look at other areas to kind of take on a little bit more risk, like an Intel. In a position to see solid revenue and solid GAAP net income growth in 2025. And with the recent raise of their dividend, this is what's giving me a little bit more confidence on Pfizer and why I think it's pretty compelling that the bottom may be in on this name. So with Pfizer trading around $26.50, most analysts believe that this stock should be trading between $30 to even as high as $40 a share. And when we factor in a 6.5% dividend yield, this could be a very nice compounder over the next few years. Now buckle up, because Paramount Pictures is possibly the most controversial stock out there. I think Sherry Redstone has driven this great company into the ground, but new management could be around the corner, and this is why I'm buying Paramount Pictures. I got in around $10.20. It is currently trading at $10.88. So let me talk about why I really like Paramount Pictures here. It's actually not just the library, not just Nickelodeon, not just MTV, and not just the fact that it's possibly trading around 8 times forward earnings. What makes this one interesting is what I think is their largest asset of CBS. We can see here Paramount has a market cap of $7.2 billion. It's doing revenue around $28 billion. Book value is sitting at about 50%, which means that if Paramount liquidated, there could be 50% upside in this name. Now, to me, CBS is one of the most interesting assets overall in all of streaming. I think it's one of the most underrated assets in all of streaming. They have a contract with the NFL going from 2023 to 2033 at $2.1 billion of annual value. Just CBS and CBS's annual value with the NFL exceeds the whole market cap of Paramount as a whole. And so this is why I'm looking at this as more of an asset separation than I am as a company as a whole. If they had the right management in there executing, somebody who really understands entertainment and partnerships that could be around the corner with companies like Disney, I definitely think this asset is tremendously undervalued when we compare them to their peers, but it's undervalued for a reason. Once again, these are the dogs. I'm not buying the high flyers trading at 20, 30, 40 times earnings that have growth rates. I'm looking at the ones that could really surprise the market to the upside and have 50 to 60% upside. but also have some pretty high risk as well. Schwab has no rating on the company. Morningstar thinks it's a 4-star company, and most analysts actually have this as a sell rating with a $10 to $9 price target. Morningstar believes this could be closer to a $20 asset, and I tend to agree with Morningstar on this as well. I think buying it below $10 would be ideal. I got around $10.20, so we're only talking about 50-60 cents that maybe I reached on. And oddly enough, the bull case on this is that CBS is overlooked with the NFL rights, and I couldn't agree more with this, and this is exactly why I'm buying it. I'm essentially investing in the NFL more than I am in Paramount. Once again, ladies and gentlemen, do not try this at home. I'm literally buying the dogs of the stock market, and they're dogs for a reason. But I also think there is a lot of upside in all these names, especially when we look at a market trading at 27, nearly 28 times earnings. I definitely want to be overweight cash for a possible correction in this market to capitalize on higher quality names that get a little too cheap. But as of right now, that is really few and far between. That's why I'm picking up some of these stocks that are trading well below book value with the hopes of a turnaround here. As always, this is just my strategy for 2025, and we will go over the small cap names that I'm starting to accumulate as well in the next video. Thank you all for your time, and we will see you all in the next one.